The chart right in front of me is flashing green. CleanSpark Inc., ticker symbol CLSK, is currently trading at $12.15, pushing up approximately 2.75% in today's intraday action. But do not let that green percentage fool you into thinking this is a simple, calm recovery. What we are witnessing right now is one of the most confusing, aggressive, and psychologically demanding tug-of-war battles on the entire NASDAQ. If you were watching the after-hours tape late last night or the pre-market chaos early this morning, you saw this stock getting hammered, dropping over 3% initially, only to violently snap back as the opening bell rang. Why? Because the market is currently having a complete identity crisis regarding what CleanSpark actually is. The expectation, what the retail crowd and the headlines want you to believe, is that this is just another Bitcoin miner. The narrative is simple. Bitcoin goes up, CleanSpark goes up. Bitcoin goes down, CleanSpark crashes. That is the beta trade expectation. But the reality, the deep fundamental reality that is currently confusing even the institutional algorithms, is that CleanSpark just dropped a fiscal year report that fundamentally breaks that correlation. We are looking at a company that just reported $766.3 million in revenue for fiscal year 2025. That is not a typo. That is a 102% increase year over year. They literally doubled their revenue. And yet, if you look at the analyst notes from firms like Zacks or the headlines from this morning, all you see is the word miss. They are screaming that the company missed revenue estimates by a hairline margin and missed earnings per share targets. This creates a massive disconnect. How can a company double its revenue, flip from a net loss to a massive $364.5 million net income, and still be treated like it failed? This is where the opportunity lies, and this is exactly what we need to break down. Most people looking at their Fidelity investments or checking their Schwab Intelligent portfolios see a red headline and move on. They see miss and they sell. That is the trap. The smart money, the people who understand how individual brokerage accounts operate versus how institutional desks operate, is looking at the quality of that revenue. CleanSpark is no longer just mining digital coins. They are building a massive energy infrastructure empire that is rapidly pivoting into the one thing Wall Street loves more than crypto: artificial intelligence. Let's pause for a second and look at the actual numbers that came out. The expectation was that the halving event, where Bitcoin mining rewards get cut in half, would crush margins. Everyone expected profitability to vanish. Reality? CleanSpark posted an adjusted EBITDA of $823.4 million. That is nearly 4 times what they did the previous year, $245.8 million. While other miners were struggling to keep the lights on, selling their Bitcoin stashes just to pay for electricity, CleanSpark grew its Bitcoin treasury to nearly 13,000 BTC. They are holding over $1 billion in liquid Bitcoin on their balance sheet, while simultaneously generating almost $1 billion in operational EBITDA. So, why the volatility? Why the initial drop? It comes down to dilution fear and the AI pivot uncertainty. Investors in Robinhood stock trading forums are panicked about the company selling shares to fund growth. They see the company raising cash and they think dilution. But look at what they are buying. They aren't buying yachts. They are buying 271 acres in Texas with 285 megawatts of power capacity. They are buying the physical land and the electrical grid access that NVIDIA stock bulls are desperate for. Think about the broader market context. You have Tesla stock soaring on robotaxi and AI dreams. You have Apple stock trying to convince the world it is an AI company. And here is CleanSpark, a company that actually owns the power, the electricity required to run those AI data centers, trading at a PE ratio of around 13 or 14. That is absurdly low for a high-growth tech infrastructure play. If you were looking for investment help or using a SoFi robo-advisor, the algorithm might flag this as a value trap because of the crypto risk. But if you analyze it like a self-investing pro, you see an energy arbitrage play. CleanSpark has surpassed 50 exahash per second in operational hash rate. To put that in perspective for your friends who might just invest online casually, that is an immense amount of computing power. It puts them in the top tier of global miners. But the expectation was that they would hit this target and stop. The reality is that they are now looking at their massive power portfolio and saying, why use all this for Bitcoin? Why not lease some of it to the AI giants? This is the tension point. The market doesn't know how to value a hybrid. Is it a miner or is it a data center REIT, real estate investment trust? If it's a miner, it trades at 10 times earnings. If it's a data center company hosting AI, it could trade at 50 times earnings. The stock is currently priced as a miner, but the business model is shifting towards data centers. If they successfully sign a tenant for that Georgia or Texas facility, maybe a massive cloud provider or an AI startup, the valuation multiple could re-rate overnight. I want you to pause right now and comment below how many shares of CleanSpark you currently hold. And more importantly, are you holding them for the Bitcoin exposure or are you betting on this AI infrastructure pivot? I really want to see where the sentiment is in this community because the volume we are seeing today suggests a massive rotation of shareholder base. Let's talk about the miss again, because it is critical to understand why the stock dipped and is now fighting back. Analysts expected $783.9 million in revenue. CleanSpark delivered $766.3 million. That is a difference of about 2%. In the grand scheme of things, a company growing at 100%, a 2% variance is noise. It is a rounding error. But in the world of high-frequency trading and interactive brokers' stock trading algorithms, that miss triggers automatic sell orders. That is what happened yesterday. The algos read the headline, saw revenue miss, and dumped the stock. Now the humans are waking up. They are reading the transcript. They are seeing CEO Matt Schultz talk about operating leverage and transformative years. They are realizing that the company net income is positive, $364 million positive. For a long time, the knock on Bitcoin miners was that they were incinerating cash. CleanSpark has proven that narrative dead. They are profitable. They are cash flow positive on an operational basis. This brings us to the macro environment. We have Bitcoin hovering near all-time highs, despite some recent cooling. The expectation is that as Bitcoin goes higher, difficulty increases, making it harder to mine. That is true. But CleanSpark's efficiency, their fleet efficiency measured in joules per terahash, is among the best in the industry. They are upgrading their machines constantly. While you might be browsing investing sites looking for the next penny stock, CleanSpark is spending millions to ensure they use less electricity to mine the same amount of Bitcoin. That is a competitive moat. And let's look at the competition. You have Riot, you have Marathon. They are massive, yes, but CleanSpark has consistently executed on its hash rate targets faster and more reliably than almost anyone else. They don't make big, flashy, empty promises. They just plug machines in. The reality of their execution is boringly consistent, which is exactly what you want in a volatile sector. But we must address the risks because online investing is never without them. The expectation is that the AI pivot is easy. Just unplug the Bitcoin miners and plug in the AI servers, right? Wrong. AI data centers require different cooling, different redundancy, different latency standards. Tier 3 data centers are not the same as a container in a field mining crypto. The risk is that CleanSpark burns a lot of cash trying to upgrade its facilities for AI clients who haven't signed contracts yet. If they spend $500 million building AI racks and no one rents them, the stock goes to single digits. That is the bear case. But here is the counter-argument, and it is a strong one. Power is the bottleneck. You can buy NVIDIA stock all you want, but you cannot run an H100 chip without electricity. The queue to get new power connections in the United States is 3 to 5 years long in many places. CleanSpark already has the power. They have the interconnect agreements. They have the substations. That makes their real estate incredibly valuable, regardless of whether they mine Bitcoin or host